here and his panelists virtually.
Well, thanks, Tim. Thanks, everybody, for coming back to this joint session with the Venture Capital and the PE Leaders Summit and also LP Summit. Today, we are here to talk about luxury problems. Benson, we were chatting a little bit off the stage. Looks like it's been a very, very good year for the investment world. I'm Henry Yang. I'm partner and head of corporate practice in Cooley's Beijing office. We've been very busy this year. We've seen larger deals, larger fund sizes, and really exciting trends everywhere. And as I was talking to Benson off the stage, I got a quote from Benson. This would be the point of maximum chaos and panic, which translates into buying opportunities. So we'll talk about where the market is right now, and we'll talk about how the funds with ever larger sizes and opportunities respond and react to the growing challenges of diversification, of strategies shift. And we have a really great panel today. We have people joining from us online. I cannot see them, but joining from us would be James, Kichiro, and Abhe. We'll have the panelists introduce themselves. Why don't you go first, Benson, my co-pilot?
Well, thank you, Henry. So let's see whether people are alive and awake. Hello, everyone. Great,
hey,
excellent. So it's me who said it. I said this is the point of maximum chaos and panic. In my 30 years of doing private equity and venture capital, every single crisis is a moment of opportunity. We made a lot of money after the first Asian crisis in 97, 98. So all the way to this last one. We picked up excellent assets last year at the maximum point of COVID panic. This year, it is China Tech. So I'm Benson Tam. I've been doing private equity and venture capital since 91, 30 years. I've now changed my spots. I'm now founder and chairman of a company called Venturous Group. What we do is we make cities smart. We focus on becoming China's leading city tech group. And by that, what we mean is that we use a group structure, which is both permanent and listable, to build across cities in China. Right now, we are already present in 170 of the 800 smart city districts that are already being built out in China. This is something that we can talk about today. Smart city as an emerging market right now is predicted by next year to be about $4 trillion US. $4 trillion US, just China alone. And that's what we're going to tap. And that's me.
And that's exciting, Benson. Next, we go to James. James, share with us some exciting news from Lightspeed.
Oh, hello, everyone. I can't see the audience, but I guess Zoom can improve their features in the future. But it's happy to be here with everyone. I'm James Mee, founding partner of Lightspeed China. I'm dialing in from Shanghai. And Lightspeed China is China dedicated venture capital fund. We focus on early stage investment in China. And as we have also grown to have a growth fund on top of early stage fund, and also in collaboration with our partners, Lightspeed US and Lightspeed India, that we also had the late stage opportunity fund that we really support our top portfolio companies all the way to later stage. So we invest different sectors, and initially we certainly put the heavy bets in internet space, but China dynamic, as Benson mentioned, over the years has a lot of changes, and our current investment focus, the biggest one actually is green tech related technology companies, and followed by deep tech and the financial enterprise services. Consumer internet is just maybe 20% of our total fund exposure. So happy to be here and chat more.
Thanks, James. Well, next, maybe Kichiro. Can you introduce yourself from Japan?
Yep. Hello, everyone. My name is Kichiro DeLuca. I'm head of research at Waru Investment. Our claim to fame is that we're actually the first and oldest university-affiliated venture capital firm in Japan. Partly because of our roots, our focus is on early-stage investments in in a number of cases, which are spin-outs from universities and research institutions. Geographically, we cover Japan as well as globally, primarily in the U.S. And we're sector agnostic, but we cover a number of industry sectors, everything from biotech and pharmaceutical to everything in between, to frontier areas such as space and others. I think it's an exciting time to be in venture capital right now. From our perspective in Tokyo, we look at a lot of what's changing geopolitically around the world. And from there, making a number of critical bets in spaces such as commercial space, cybersecurity, and other critical industry areas. So it's very great to be sharing the panel with everyone, and we hope to provide our vantage point from Tokyo. Thank you.
Thanks, Kichiro. Last but not least, Abhay from India.
Hello, everyone. My name is Abhay Pandey, and I work with A91 Partners. We are a late venture early growth fund that was started just under 3 years ago. It's a spin-off or spin-out from Sequoia Capital. A bunch of us started out afterwards, working for over a decade at Sequoia. We focus on tech-enabled businesses in consumer, healthcare, and financial services targeting the domestic market in India, and pure software businesses focused both on the Indian market and the global markets. That's the core of our business. We are on our second fund, so very early in our journey as a business, as a franchise, as a partnership.
Thanks, Abhay. Well, looks like everybody had a great year or over the last 2 years, and what we are seeing is growing fund sizes and growing opportunities. I think our first question would be, what are the implications of ever larger funds across multiple strategies? Do you need to shift or plan to shift your strategies and focus on different things with a larger AUM? We'll throw that question out, and I'll get maybe James to respond to that first, and then we'll have the panelists join the discussion.
Sure. I think we have been doing this for over 10 years in China, and initially we always has been very focused on early stage, and intentionally we kept the fund size limited. But as we grow the team capability and opportunity sets expands, we increase early stage fund size gradually. But one thing we realized that many of the top portfolio companies, when we invest in Series A, we have 20% ownership. As we grow to Series B, you can do pro rata investment. But get to Series C, actually you, with all the pro rata rights, and we actually are capped out. So we developed this growth fund. Half of our growth fund investment are in the top portfolio companies that get to the Series C round, and we think there's at least 5x or more return. And we have known them for a long time and know their track record. And so this is actually a natural evolution for our growth strategy instead of going out to hunt for net new deals for the growth stage. But increasingly we are seeing some of the networks we are building, and we have additional net new deals we can do for the growth fund. So right now we are at probably early stage fund is about 450 million, and the growth stage fund is about the same size. Mm-hmm. But we also have this late stage fund, which we, as I mentioned, working with Lightspeed or other partners in other geographic regions. And we really saw a lot of the top companies are expanding, not just in the China market, but beyond that to the global market. So we can support them with a single check, $100 million we can cut for them as they to support their global vision. But I think it's very important for us is constantly our funds is always oversubscribed, and will always kind of remind us that you really have to manage the size, and otherwise you can get carried away very easily, because LPs will some of them will really encourage you to have a bigger fund size, but not necessarily sometimes can match with your the total strategy. So that's something we have to remind us.
Mm-hmm. Thanks, James. Kichiro and Apple, how do you react to the luxury problem of growing fund size? Do you feel the same pressure from the LP, try to diversify the strategies, and how do you shift the investment stages and strategy?
In our case, I actually echo James's messaging a little bit in that we also started out as a primarily early stage firm, but opportunistically in recent years have built out growth funds to capture later stage growth in portfolio companies that we've supported in our flagship early stage funds. So that's not necessarily as a result of pressure from our LPs, but that's something I think is happening across the board in the VC world. Not just in Asia, but also across the board around the world. One thing we actually do in addition to that is to provide other strategies for our LPs that include public strategies both in the equity domain and credits domain. So that's also another thing we do. But I think overall, because of larger fund sizes, and there being much more capital at play in later growth stages, that's resulted in increase in valuations overall, in various different geographies.
I see. Apre, maybe you can share with us your ambition.
As far as the India market is concerned, it's not very different from the rest of the world, where the size of the rounds are expanding, advanced rounds are getting done ahead of businesses. And the lines between Series A, Series B, Series C are all blurring. And as fund managers, we have a constant battle between relevance and returns, depending on the fund size. I, as a GP, may want to be super focused because I want to deliver returns. But if you have a small fund operating in a part of the market while everybody else is expanding, you start losing relevance in the market. And you get to see less and less. And therefore, it's important as a GP to even have some expanded space, some more elbow room, seem more relevant, seem more important in the market space, being able to tell your companies that you can support them in the subsequent round and so on. Well, you also know that as you do that, your returns over time will suffer. It's a constant battle. We are early in our life. We took the call that we'll go from 350 to 550. And that's after all the pressures from different LPs. On one, LPs would have wanted a smaller fund, new LPs would have wanted a much larger fund. And it's a constant battle that we're all, as GPs, chasing in a very, very unprecedented market today. But it's a real issue. I think the answers here are more organizational and so on. It's not about every individual and every GP thinks that they can manage across stages. What's the big deal? But we know that it's really hard. You need to focus on a certain stage and do it well, and then you may earn the right to do a later stage better. But when you're sitting inside a company, you didn't done the Series A, it looks like, hey, I know this company better than everybody else. What's the big deal? I can do B and I can do C and I can do the pre-IPO. But we all have to pick our spots, and over decades, firms like Lightspeed and Sequoia have managed to do this. And I suspect other firms over time will do this as well. But this is daily and a constant struggle that we all deal with.
Mm-hmm. Speaking of doing hard things and constant struggle, Benson, I think the strategies you have, the investment styles you have at Venturous Group, you do early stage deals at the very beginning, 25%, building up to 50%, and then do buyout. Looks like you are doing the hard thing from the very beginning. Maybe you can share with us.
I do want to talk about maturing of this industry. The way that I see it is that we are exactly like all industry. We will mature. Okay, private equity started as very alternative, very esoteric. But what we are seeing right now, if you look at what Sequoia did, we are turning as an industry into public equity type structures, okay? So this thing is happening. I've been in this for 30 years, and what I'm seeing is that, and China is speeding along. The first thing is that it became very, very crowded. Right now, there's probably 10,000 to 20,000 private equity venture capital funds inside of China, okay? So within China, this product is fully commoditized, okay? Perfectly competitive, and everybody getting to that stage. That's the first stage, and that's the sort of commoditization. We are now entering, as you see with what Sequoia is doing, is that everybody is now shifting to an AUM model, okay? What is that doing? We are consolidating. Just like in the public equities, starting with lots of tiny little investors, you ended up with just a few. In Chinese, we call it 头部. In English, I guess we say these are the premier top ones, okay? Within the 10 to 20,000 PE VC firms, something like 0.1% perhaps will win 95% of all the deals. Look at Silicon Valley. So this consolidation is happening. AUM gets much bigger. Branding is very important. Two of the biggest firms inside of China recently was in a bidding war for one particular talent who is my friend. Guess what? He does PR and IR. He's not an investor. Why? Because they need to build the brand, okay? Why? Because the perfect commoditized industry you can see is buying petrol. Petrol is the same. That's why you go to a gas station, they start branding it. They start having all these super duper additives to it, just because you buy them. The same is happening in the Sequoias, the Matrix, all of these other sort of firms.
So,
I think
so. In this conversion world, in this commoditized world where PEs are doing earlier stage deals and VCs are going late stage with larger fund sizes, how do funds really differentiate? I mean, you cannot just hire IR or PR person to really build a brand without going into something much deeper in the infrastructure of the funds.
Thank you. Exactly.
Yeah.
You got to be much better. Just like James is doing, they start to segment into early stage, middle growth stage, late stage, and in the case of Sequoia and Newshan, they're going into public markets. So you are segmenting, okay? The other thing is that I think, to be honest, I always say to people, why should you focus in a stage? A good deal is a good deal. I don't care what stage it is. If it makes 10x, I'll do it. Okay? If the risk makes sense, I'll do it. We are completely stage agnostic in my previous life when I did it. Right
Many
now,
funds would not have that luxury though. If you ask probably Abhay or Kichiro, your LPAs probably would not allow you to do certain stage of investment. So the question really is, we come back to the question when in a commoditized world, when sometimes your hands could be tied by your own strategies and the initial fundraising process, the stories you've been sharing with the LPs. How do folks differentiate and take advantage of the ever larger market and fund sizes?
Yeah.
I would like to hear the views from James, Kichiro, and Abhay as well.
Yeah, I think there's a lot of capital for sure, and the capital knows, and we see the trend that the LPs wants to put more capital on the conviction bet, just like what we invest, right? And we invest in companies that very high conviction, we want to get ownership. So LP really want to get into the top fund with the capital allocation, and sometimes it's difficult for the top funds. But I think besides the supply of the capital for the top funds is sufficient, it's plenty. I think the challenge I think the different funds are facing is there are a lot of funds, as Benson mentioned, and there are different spin-out funds. I think we have seen this in in the US and it's repeating in China. But eventually, the funds can really deliver consistently, fund from fund, and also be able to adapt to the changing environment. And this year, starting in July, and we are seeing a very big shift, I would say the turning point for consumer internet space in China. The big platform companies like Meituan, Dianping, and Pinduoduo, which I invested very early on, none of these big platform companies are available. And Pinduoduo I invested 6 years ago when they just started. But since then, we have did very little consumer internet deals. But the much more bigger opportunities are, for example, frontier tech, and you really have to be able to build a team with the expertise to make judgment on the early stage side to capture those opportunities. But not that many funds can really do that. So I think it's, other than the capital side, I think the changing environment posing challenges for these fund managers, and whether you can build a team, has the leadership and really have the expertise to capture those. I think that's something we always remind ourselves. It's always day one, right? And I have done chip design at Intel, but also built Google China from scratch. So a little bit fortunate, I kind of dabbled in the consumer internet space and also the frontier tech. But that's something we continue to have to build these top quality team with the really the capability. So that's not easy. So eventually, I think it will settle down. I think, but everybody has to really evolve to learn, have a growth mindset to be able to adapt to it.
Yeah, I agree, James.
So I think James had a very good point there regarding having the right team to be able to execute on a early stage strategy. And while it's true that seeing the top VC funds out of Silicon Valley moving much further and further into early stages, and even seeing PE funds moving upstream. But I guess speaking from the perspective of early stage focused fund that focuses primarily on frontier technology areas, it's a very different game. And in later stages, it's really about being able to see the cash flow, being able to see the business model in practice, and how that can be optimized. But really, in the early stages, you don't have any of that. And what you're left with is your understanding of how the world is evolving, how technology is evolving. And there's a very vast barren land between that understanding and being able to formulate a investment hypothesis that can be executed on. And we call this being able to leap in our understanding and in the investment strategy. And that really requires a very different mindset that something that's maybe a little bit more academic and philosophical in nature. So we actually see a lot of opportunity, even for us there, in being able to differentiate and compete with the larger capital pools moving early upstream to early stages.
Mm-hmm. We would like to hear Abhay's view as well. Yeah.
Differentiating oneself in a market like today, where, as we all agree, capital is as commoditized as it has been in the past, is really hard. But finally, what does brand in our business of venture capital mean? It really is a function of performance and behavior in the market. Performance takes time. You cannot create performance. It takes few funds and series of funds, and then founders get attracted to come to funds that have performance, saying, hey, you know what, I want to be part of that portfolio because they have AVCJ companies and I would love to be in that portfolio. Or this particular partner has been on the board of AVC companies. I want him or her on the board of my company. So that is performance-based reputation that is created. And the second thing that we have to do, which is not, it is created over time, but is a function of daily activity, is how you behave in the market. And daily behavior is something as to how you treat people. Do you come to meetings on time? Do you follow up? Are you keen? Are you knowledgeable? Are you asking the right questions? Are you showing them in the right direction, et cetera, and many things that you have to do on a daily basis, which is just to stay at par with competition. And how do you get ahead by doing the same things better and better than them is really knowledge. And this can be done by going deep, and that's where focus becomes important. And it's easier said than done to say, we can do a lot of things, but you cannot be knowledgeable about many things. You can be knowledgeable about a few things. So to build that reputation, that credibility, and that therefore the brand, in addition to performance, it's about doing the same thing well over a decade. And that's really hard to do. And that's the reason ones are not able to scale up or not able to consistently perform and fade away over time. And very few firms have built franchises that have lasted decades and decades. And that's the challenge in front of the 10,000 to 20,000 fund managers or GPs that exist in China today. And that's the reason why very few of them will survive onto their fourth and fifth funds and then survive for many decades. And that's what we all need to do. So the goal is pretty clear. It's really hard to do.
Yeah, I totally agree with you, Abby. Behavior in the market. How do you treat your co-investors? How do you treat your CEO? How do you treat your teams? Is so important. And yet, almost a lot of the funds don't focus enough. I mean, that's why a lot of, James is a long-time friend of mine. We both live in Beijing for the longest of time, and I have a lot of respect for him because he's just a gentleman, first of all, and he's then very, very smart, okay? And I think what he's done, in a sense, is a case study. Get very good at one thing, get to a strategic adjacency, get that done as well, then do a third and then a fourth, and before you know it, you start to cover various parts of the life cycle. Meanwhile, you just keep building up stuff, and the cycle then comes. But behavior is so important. I totally agree with Abby. And I think sort of one of the things we want to do at Venturous Group is that we have a certain reputation that we treat people well, especially when things are not going well.
And then I can know with that, I think when these days, when your portfolio companies and the targets look for investor partners to work with, they really look for the kind of support, long-term support that those funds and the institutions can give to them. And with this growing economy, we are seeing there are more and more pan-Asia or global, the kind of global Asian startups, and they are growing. The fund's focus may be on certain geographic areas or certain stages, but your portfolio companies are growing into much larger things. So how do those institutions like yours support the kind of global expansion of your portfolio companies? What kind of stories and value you would be sharing with them and your LPs? That question is for everybody, particularly for James. And James, I'll give you a chance to say nice things back to your friend Benson on stage.
Well, pressure is up. It's I think when Benson was at the Fidelity, I think that they really would view global investors as really a global insight. I think that's something we really appreciate. I think now we see more and more Chinese entrepreneurs from day one, their ambition is we'll start in China, but eventually we want to get to globally. And consumer internet is a little bit harder. You have seen success in TikTok, but with more tech companies, you have seen DJI, and we have a portfolio company for autonomous driving cars, LiDAR, laser-based radar. It's a company called Hesai, and they are not only number one in China, but pretty much every top US autonomous driving car company, including GM Cruise, everyone else is using Hesai as a LiDAR product. So what we did was, and fortunately, I think we collaborate very closely with our colleagues in US, in India, in Southeast Asia, in Europe, in Latin America. We have about 100 people in US, right? And but sometimes you really have to do the heavy lifting yourself. And this is a story that Hesai, when they are taking significant market share from another leading player in US, that company actually sued Hesai. So actually, I flew to US Silicon Valley and had a strategy meeting with the top IP lawyers, and we were fighting that lawsuit. And the outcome is very positive. And the other company dropped the lawsuit, and eventually we had an agreement across licensing all the patents. And but this is something I think we need to really support it, because that gives outsized outcome for our venture investment, and the talent is getting there, and they can really capture the opportunities globally. And I mentioned that one key investment area for us is green tech related technology investment. A lot of people think, clean tech didn't work back in 2000, 2010, but the things are very, very different. And Pinduoduo certainly was a success starting from zero 6 years ago, now 100 billion public companies. But there is a company called CATL, and they grow their revenue mostly within that 6-year period. Now they are $250 billion US dollar public company, and they provide the battery for all the EV car company, including Tesla. So many of these technologies are getting to the point is commercially, economically very affordable, and it doesn't need a government subsidy. So we have built a lot of portfolio companies, and these companies actually we are seeing more opportunity for them to grow global, because climate change is not a problem we have to fight just in China or in US or in Europe, but it's everywhere. So this is something I think going forward, we will put more resources behind those portfolios.
Thanks, James. Kichiro and Abhay, how do you support your locally invested companies for a global expansion?
Sure. For the type of companies that we support within our funds, because of the nature of the industries and technology domains that they operate in, a lot of times it requires the cooperation of large corporations or government entities in order to cross those national borders. So I want to bring up two examples actually of things that we've supported in the past to that end. One example is a biotech company that started out as a spin-out from Waseda University here right next to us. And that company utilizes excess tendon from cows that have been butchered, modifying them to be utilized as a regenerative medical device for ACL injury patients. And that's something that's started in Japan, but recently we've connected that company to a large foreign pharmaceutical firm that's allowing that particular company to cross that border over to the US. Conversely, we actually operate and help companies enter the Japanese market as well from geographies outside. An example, a recent one, is a company called Leo Labs from the US that addresses the problem of space sustainability by tracking satellites and space debris. And that's a very particular market, very unique domain, and for them to enter the Japanese market, it's required the cooperation of government agencies in Japan, which we have connections with as well. So I think large corporates and government agencies that allows for that type of cross-border expansion is very important.
As I said in the introduction, 80% of our companies are focused on the domestic market, and 20% companies are software companies that are selling in the overseas market. When we think of the overseas markets, first we think of Southeast Asia, Middle East, and the US, of course, being the largest market. Having come from Sequoia, the founding team, all of us have spent a cumulative about 50 years working with companies that were selling in the overseas markets, and therefore have built our own personal networks of who to reach out to. And how to connect these companies to different people and different companies and so on and so forth. So it's a lot currently of our personal credibility and networks that we are bringing to the table. But we do realize that this is not sufficient. And as the active portfolio of companies which are selling in these markets increases, we're actively thinking through how to create either an operating partner model or some kind of an advisory model where we are able to provide more help to these companies. So it's best described as work in progress for us.
Mm-hmm. Would you like to share your view on this?
I'll make it short. Of course, you want to be able to help companies go overseas because in China, the best ones always want to go overseas. They are never willing to be just in China, okay? And it's hard to go overseas. So what they're looking for is, number one, I think basically the three things they're looking for. Number one, are we global enough? You know, that investor, you know, do we have the global expertise? So that's why, for example, in Venturous, we have people inside of Beijing, we have people outside of China, okay? You've got to be global because otherwise, how the hell do you help them? Number two, this is very important, this is the next stage. We need to be good executives. Don't just give them an idea and leave them to do it. That's not what they want. They need guidance, they need help, they need executive capabilities, they want people to help them execute overseas. So I do not believe in pure...
though, of not being too proactive and actually start to run your own portfolio companies?
No, you got to do it.
You have to be extremely proactive.
In certain things, especially in the initial part, even if you provoke them to do it themselves, you have to be proactive.
See.
I think the passive investing days are long gone. Look at James. James is an entrepreneur. He started businesses. You know, you go to Silicon Valley, the best investors always have an executive background, okay? So that's why in my team, likewise, I'm the only last pure investor. My partners all have serious executive experiences because that's what the CEO wants, okay? And initially, they need it. Whatever they need, we deliver. That's the second part. The third part is you've got to be people-centric, okay? How the hell do you go overseas if you don't even know how to, you know, form partnership with an overseas company? But partnerships fail not because of technology or anything else. It's always about the cultural misfit. It's always about the communication between the teams. It's people-centric. People-centric means leadership, EQ, stuff like that, okay? Three things. And that's what we as a team try to build. So in a sense, we have to do that.
I'm really interested in your view about the second issue, and I would like to hear whether Abhay or Kichiro agree with from the very beginning, your target companies, the executives and founders are really looking for extremely proactive investors trying to provide executive capabilities. Is that the case in Japan and India? Because in China, I have to say, from my experience working on all the deals, I work with a lot of founders. Sometimes they just want a check from a quiet investor.
Absolutely, and they're not for us. And we also have a sweet spot. Our sweet spot is we help companies about 300 million get to 3 billion. That's where the CEOs themselves have matured. This is no longer the charismatic CEO who go off and do the guerrilla warfare. This is a serious army with vision, mission, value systems, very organized, entire systematic thing. We've seen it happening in Alibaba. We've seen it in Wuxi Tech. This transformation, and that's why we hit the sweet spot around there. And that's where, in a sense, they need a lot of help. And we have, so the company will not be named, but we have seen companies that shot beyond the unicorn status have to come back down because everything inside is not able to support the valuation and then have to go back up again. And so it's usually the more seasoned second-time entrepreneur who realizes that they need help. I can't, just like just now, I think maybe Abhay or whoever said that you can't be the expert in everything. And the smartest CEO is always looking for help. Look at Jack. Jack found Joe and Savio, the two biggest executives who helped him. Likewise, that's how they find the right investors. Almost all the investors they have found are what they call strategic investors. Strategic meaning that they have resources, platforms, relationships, stuff like that. Okay.
Everything, yeah. Abhay and Kichiro, do you think you share the same view on what founders really want in your region? Or do they
I would say at the overall level, I think the answer is absolutely correct. Everyone needs that help. When it comes specifically to what it means for us and at the time of our investment in the company, it could mean different things for different companies, i.e., there may be companies that have already found one or two very strong investors. They may just be looking for capital. They may not want a third very good investor who's also trying to bring a lot of networks and value add and so on and so forth. They're just trying to maximize value and saying, you know what, I've got A, B, very high quality firms. I've got what I need. They've helped me hire a few people and I'm on track. I just need to maximize valuation. But there are a number of companies that we go where the founders may or may not state that as explicitly, but we know they need help. If somebody else hasn't done that for them well before us, the onus is on us for making sure we do it. And I would say that if you are the first, second, third investor, more often than not, you have to do it. And as you become the fifth and the sixth investor, maybe just capital is required and nothing else. And then they might even say, leave me alone, don't bug me too much. I'm okay without your help.
Right. Kichiro?
And I would agree. Both in Japan and the U.S., the portfolio companies that we've seen that have done very well are cases where we have been, very proactive, both as investors but also as board members as well, in being involved with the executive role from the very beginning. So whenever there's a good match there and collaboration in that regard, we've seen things go very smoothly, in Japan and the U.S.
Right. We have 2 minutes. We have 3 minutes left. In fact, I would like to invite the audience to ask questions you may have. Because the iPad is not working, by the way. We are not seeing no questions from online.
Any burning questions?
If we do not have no question from the audience, I do have one last it's a very casual question. I want to ask each of the panelists to reconfirm and just in one sentence tell everybody your geographic and strategic focus. So it's really just to give you another opportunity to reiterate the branding, the marketing information. And the question is, if you are forced to give up your own geographic and strategic focus, what other panelists focus would you like to pick up and why? So one sentence and one trick question. We'll start with Benson. And you are not allowed to pick James. I know you are a big fan of James, but this is too much for me.
Okay, so one sentence, I'm in China, I'm in tech, we focus on smart cities. Okay? That's what we do. We don't do anything else, that's what we do.
If you can do that.
If I can't do that, that's very difficult because frankly, I've been living in Beijing and China for 19 years. I really don't know anything else anymore. So, tough.
That's fair enough, and we know secretly, you actually.
I would say, basically, I'll tell you this. If I didn't find Venturous Group, China and smart cities, actually, I retired in 2012.
Wow.
So my answer to you is I would go back to retirement.
Awesome. James?
We are focusing China in the early stage with some growth capital capability. If I have to pick another market, I would probably pick Africa.
Wow.
Good choice.
Okay, good choice. Kichiro?
Okay, so we invest globally, but with a focus in Japan and the US on early stage frontier technology areas. And I would say I can't really forego the latter part of that description. So if I was to go to another geography that's represented on this panel, I think both India and China are great choices, primarily because I love the cuisine in both geographies. So, I could picture myself living there, and both are very big tech powerhouses. So, a place where we could continue to do what we do currently.
Awesome. Après?
We are totally focused on late venture, early growth in India. That's what we know. That's what we do. We do not understand any other geography or any other business, and therefore we'd love to continue doing that. If forced to pick something else in life and do, I would probably do what, if you guys know, Paradigm Capital and Matt Huang in the US. This is a fund focused on Web 3.0. So if you have to learn something new, I would want to spend more time learning that, given what the prospects potentially could be. But it's far